Happy Wednesday. It's great to have your company on this 11th day of February 2026. My name is Jessica Amir, a market strategist here with Moomoo. Lots to cover, so strap in. So the Dow Jones has hit another record all-time high. It's up 4.4% this year. Australia's market is doing better than that. It's up 8%. Emerging markets are charging no. Just a quick update on those. Brazil's market is up 22%. Japan's market is now up 16%. It's outperforming the US benchmark. We've got the S&P 500 only up 1.4%. The Nasdaq 100 mega cap tech index is down. Under the surface, though, we have been speaking a lot about the key themes that have got a lot of hot sauce, a lot of gusto, whatever you want to say, behind them: materials, healthcare, industrials, and select high growth stocks. They've all been charging, but you really have to be stock specific too. And overall, these themes are playing out. So is the narrative bullish for the market? Well, the answer is yes. So we've got AI spending on Mag 7 now hitting a new record, 76.1 billion. That's 75% up than the same time last year. Bank of America overnight saying consumers are strong. They are seeing strong spending of 5% year on year. That's despite the headline US retail sales data overnight unexpectedly falling. So lots of really bifurcated signals. UBS Wells Fargo also saying the US economy is strong and resilient. And yet, wait for it, we're still waiting for that big, beautiful bill, $1 trillion US dollars in size, in stimulus, yet to hit overall. So overall, we are seeing S&P 500 earnings being upgraded for the year ahead. This is great to see, and this is supportive of the overall bull market. Earnings so far this earnings season are up 13%. That's slightly better than expected. I remember the market was only expecting earnings growth of 12.9%. So the US market and other markets, including the Aussie market, are entering the fourth year of the bull market. History shows the fourth year is not as strong or as positive as the prior ones, but we do need to consider bull markets generally last 5 to 7 years, and some have lasted 11 years. And why could this narrative continue? Well, in those cases where we saw markets rising more than 7 to 11 years, we had earnings growth and structural change. But I guess you could argue that is probably the reason for why we could be expecting more earnings growth ahead and for the bull market continue, because we are seeing growing productivity because of AI. But as I said at the outset, we really need to be stock specific, focus on momentum. So let's dive into that today. So yes, Australia, we are in a bull market too, obviously with our market up 8%, outperforming the US. Thank hallelujah for that. So remember what's underneath the surface of our market? Well, there's a couple of things I wanted to pause and reflect on that. So 34% of Australia's companies have reported so far this earnings season, beating expectations. We're seeing earnings growth of almost 10% year on year, and earnings are being upgraded for the year ahead. The average analyst is now expecting earnings growth for the Aussie share market. The ASX 200 company is expected to see 13% growth ahead. So that's basically painting a bullish picture for the market despite interest rates rising. So we've spoken about the crux of or the Aussie share market. Now let's dive into the makeup of the Aussie market. So the biggest makeup of the market, 44% of the ASX 200, is the materials sector. And we've spoken a lot about the materials sector delivering far better than expected earnings, 284% year-on-year earnings growth. This is the hottest earnings growth we've seen from anywhere in the market. But the other big part of our Aussie share market, banks, they make up about 31% of the ASX 200. And financials, their earnings are not up as far as mining earnings up in triple digits, but financials or banks, their earnings are up 3% year on year. Definitely not exciting and getting anyone jumping out of bed anytime soon. That's for sure. But banks' earnings are expected to be better ahead, thanks to interest rates rising. So not very good for consumers, but it's great for banks. Earnings for banks or financials now expected to be about 7% year on year ahead. So which bank do you watch? Given Earnings for the year ahead are expected to be better than what we're currently seeing now. Well, we've spoken about the RBA just increasing interest rates for the first time since 2023. A couple more rate hikes should be expected. Yes, it's not good for mortgage holders, but banks are going to win regardless. That's exactly what the market is telling us with banks' earnings being upgraded. But you have to really pay attention to the fact that we've got loan growth rising in Australia. The last read showed loans rising 10% quarter on quarter. We'll get an update on that today. We know, secondly, business lending is rising. Thirdly, commodity and financial trading is rising. So who does this benefit the most? You could argue this sweet spot really puts Macquarie in the rule of the roost. So Macquarie yesterday announced that they're growing more market share of the Aussie market book. They've now got a 7% market share, and that's valued at $172.2 billion. Sure, it doesn't seem like much in comparison to CBA, but it's really about the growth picture. Remember, that's what we look at in the investment world. Also consider that deposits from banking and financial services from Macquarie are actually growing quicker than expected. They grew 6% to 204 billion. And we do like seeing that they've got surplus capital. That means that they can double down and invest in where they see growth tailwinds. Think about AI. As for Macquarie's outlook, Macquarie said themselves that they're going to see a higher income ahead. That's driven by commodities, their global markets business, and they're also seeing strong performance in assets management. And that's why they're growing market share and funds under management as well. But Macquarie shares are obviously on the back of this and the expectation that they continue to do well. Their shares are doing well too. They're up 7% so far this year. A very different story, CBA. CBA shares, they're on the nose, they're down this year. And today they announced their results and their outlook. And yes, it's weak. Australia's biggest bank, they've got a 25% share of the Australian home loan market. And CBA is expecting profit to fall 2 to 5% in the year ahead. And that's on weaker margins and weaker credit growth as well. They're also being weighed down by higher costs. We're going to get to that in a sec. So all in all, margins, which we look at in the investment world, or it's called net interest margins, they're not attractive, but they're still around 2%. That's kind of where they've been on average throughout history. Again, not very exciting when you're seeing some tech or mining companies deliver earnings growth of triple digits when CBA is guiding for a margin of 2%. Anyway, CBA has continued to see further pressure from rising competition. That seems to be a theme that they say every half year. But they are still seeing loan volume growth, which is really pleasing for shareholders. And it's also pleasing for a lot of us which hold CBA, given CBA is the biggest stock in the market. And that means if you hold an ETF that invests in the ASX 200, you are investing in CBA. But again, if you are trading or investing here, this is a real reminder that you really need to be stock specific here. So you might be thinking as CBA is a trade and maybe invest in Macquarie. That's something for you to consider. But nevertheless, let's look to the trading watch list and kick off with CBA and dive deeper into their results. So in case you haven't been aware, CBA shares are still down. They're in, I guess you could say, a bear market. They're down 17% from their record all-time high that they hit a little while ago. But I would argue for you to consider this, and I've brought about this argument before. Each and every time CBA shares have fallen from their highs in the past, they've recovered and subsequently hit a new record all-time high. Will that narrative continue? I suspect probably, given the fact that we've said that it's the second biggest company on the ASX and ETFs tracking the ASX 200, basically forced to buy CBA each and every quarter. But nevertheless, you've got to consider that every single broker or analyst out there is still saying, don't touch CBA with a 10-foot pole. They're saying it's still a sell. And its results are obviously not that encouraging as well, which is why I think CBA could potentially remain a trading stock for you, not perhaps an investing one. But some good takeaways. If you are looking at CBA, why would you invest in it? Well, you might be looking to think about its long-term future or its dividends. As for its long-term future, CBA is really diving right into building out their AI capabilities. So they're spending billions of dollars on this. They haven't really quantified what exactly they're going to spend or how much they're going to spend on AI, but it is pleasing to see, I guess, that they are spending almost $7 billion on I guess they're calling it expenses, and some of that is including infrastructure development as well as cybersecurity defenses. But they also did see an increase in expenses totaling almost $7 billion because they're being hurt by inflation. But nevertheless, the overall narrative is they are spending more on AI. As for other things you need to know about CBA's results, well, their lending division is growing faster than the industry average. So if you are an investor, you might see that this is a good news signal. They are gaining more market share from NAB. And that's also benefiting the size of their flagship home lending business. Last but definitely not least, going back to their dividend, they have actually maintained a dividend payout ratio of 74%, and they've declared a half-year div of $2.35 per share. And all in all, that'll probably give you a dividend yield of 4.5%. So it's pretty not that bad if you are looking for a dividend play. Let's move to Spotify. So Spotify shares charge 15% overnight. That's its best one-day gain since 2019. And of course, that follows a better than expected readout of their quarterly earnings. So their stock is now $476. It's still well down from its June high of $785. A couple of things you need to know about Spotify. So many of you may use Spotify. Perhaps that's why the users are growing. They saw 700 or rather 300 million users engaging with their Wrapped end of year Wrap promotion, and they gained 9 million premium subscribers from that. All in all, they've got 751 million active users on Spotify. That's a gain of 11% year on year. Now, regardless of premium subscription fees rising, people clearly don't care. And this is exactly why Spotify's material lines are rising. So they're benefiting from that. So Spotify's net income up 7%. They declared their income in euros, so that hit 4.53 billion. A gross profit also rising by strong double digits, up by 33%, far ahead of its expectations as well. What's ahead? Well, Spotify sees revenue climbing to 4.5 billion, gross margins of about 33%, and 8 million more active users. Let's change it up and go to a car maker now, and that's Ford. Ford shares are moving up despite delivering their worst earnings numbers in 4 years. What the market does like, though, is that they're guiding for a brighter 2026. The company declared a net loss of 11.1 billion, and earnings before interest and tax that hit 1 billion. All in all, revenue hitting about $46 billion. So why did their result be declared as one of the worst in about 4 years? Well, a couple reasons. It was largely weighed down by an almost $20 billion write-down on their electric vehicle business, and also seeing soft demand for EVs as well. And last but not least, don't forget that they got hit by tariff charges like a lot of vehicle makers as well, thanks to the US government, a la Trump. As for their outlook, it's pretty strong. Operating profit expected to be between 8 and 10 billion, and earnings growth expected to be a high single digits, 8% by 2029, beating its own prior estimates as well. So all in all, pretty pleasing numbers from Ford and Spotify. As for banks, well, you make up your own mind. Take care. Happy trading.